This split-screen chart illustrates how modern portfolio theory relies on a strict set of assumptions. The left side models the standard expectation. Equities and gold move in opposite directions. Financial theory dictates that when growth slows and the stock market falls, investors rotate capital into gold as a counter-cyclical anchor. The market shocks of 2022 and 2026 shattered that assumption. During these stress events, the inverse relationship evaporated. Stocks and bullion plummeted in synchronization, entering a correlation-to-one event. This synchronized crash sequence also appeared during the systemic panic of the early 2020 lockdowns. Across the board, major asset classes sold off rapidly, regardless of their theoretical risk profile. If gold is recognized as the ultimate safe haven, it raises an obvious question. Why does it crash alongside the riskiest equities during the precise moments investors need it most? Asset non-correlation is a conditional state. It is governed by the mechanics of global liquidity and real interest rates. To survive a liquidity panic, investors must look past surface-level narratives and examine the hidden plumbing of the financial system. The real interest rate is the invisible force connecting the valuations of entirely different asset classes. It acts like a tectonic plate shifting beneath the surface of the market, dictating the movement of both growth equities and safe haven metals. The discounted cash flow equation calculates the present value of a stock's future cash flows. When central banks hike rates to fight inflation, they drive up the denominator, represented here by R. As the real interest rate grows, the total valuation mathematically shrinks. Gold functions as a perpetual duration asset with a structural yield of 0. When the real yield on a risk-free government bond climbs from negative territory up toward 2%, the opportunity cost of holding gold becomes high. This triggers a rotation of capital out of precious metals and into fixed income. When central banks aggressively hike the true cost of money, any asset reliant on the future is repriced lower, pulling growth stocks and bullion down together. The severity of this repricing depends on the central bank's liquidity posture. Moving from a decade of quantitative easing to quantitative tightening alters the market's liquidity backdrop. This diagram illustrates quantitative tightening as the active drainage of electronic reserves from the global banking system. As reserves drain away, commercial banks run up against their liquidity coverage ratio constraints. To maintain mandatory cash buffers, banks curtail lending. This tightening process strips the financial markets of their excess liquidity buffer. The immediate result is a spike in the cost of carrying leveraged positions in both gold and stocks. A geopolitical shock striking during this tightened environment hits a system with no shock absorbers. The lack of a liquidity buffer forces all assets to fall together as the system liquidates. The hierarchy of liquidity flowchart tracks the sequence of forced selling. When a shock hits, the resulting panic hammers high beta risk assets inside institutional portfolios. Prime brokers calculate the drop in asset values and issue urgent margin calls to replenish capital. Leveraged funds cannot wait for the market to stabilize. They are required to provide US dollar collateral within hours. Dumping distressed, crashing tech stocks into a falling market incurs massive slippage. During a crisis, there are often few buyers for those specific assets at scale. To survive the day, institutional algorithms target the portfolio's most liquid and profitable assets. Gold and treasuries are sold because they can be successfully converted to cash to meet immediate obligations. During the 2008 crisis, the central bank halted this cycle with rapid intervention. In the March 2026 crisis, the Federal Reserve withheld support to combat inflation, allowing the forced liquidation phase to continue for weeks. Gold's decline during a market panic reflects its role as a primary source of liquidity. In a dollar-starved environment, institutions sell bullion because it remains a reliable source of cash when other markets have seized up. It is a common misconception that all inflation guarantees higher gold prices. The reality requires separating inflation into two distinct archetypes. Supply-driven inflation is triggered by sudden spikes in energy and shipping costs. This acts as a tax on the economy, slowing growth while simultaneously driving consumer prices higher. This flow path maps a hawkish policy trap. Central banks raise rates to fight energy inflation, which drives up the value of the US dollar. This strength creates immediate demand destruction for gold in international markets. This dynamic pressures gold mining equities. A stronger dollar makes the metal more expensive for foreign buyers, compressing top-line revenue for mining firms. Simultaneously, elevated interest rates increase the miners' weighted average cost of capital. Higher financing costs reduce their profit margins from the bottom up. During an energy-driven inflationary crisis, traditional hedges break down. The central bank's aggressive hawkish policy response destroys asset valuations faster than the underlying inflation can support them. The chaos of institutional margin calls often obscures the long-term reality of the gold market. Beyond the daily trading volume are the multi-year strategies of sovereign nations. Central banks across the BRICS economies are migrating reserves away from U.S. treasuries and into physical bullion to mitigate geopolitical risk and asset freezes. This funnel illustrates the investment cascade, the sequence of capital flows during a regime shift. It begins with the top tier of sovereign physical demand. As physical demand builds momentum, institutional capital flows into royalty companies, then into large-cap producers, and finally into junior developers. Relentless sovereign demand establishes a price floor. It transforms gold from a short-term equity hedge into a long-term policy hedge against fiat currency volatility. This visualization shows why the traditional 60-40 portfolio is eroding. The middle ground, equities and long-dated bonds, face the same interest rate headwinds. Many investors are adopting a barbell approach. On one extreme, they hold allocations of ultra-short cash equivalents for immediate liquidity. On the opposite extreme, they hold physical gold and neutral reserve assets to protect against sovereign risk. This structure offers a complementary defense. The cash acts as a shield against short-term liquidity panics, while the gold protects against long-term systemic distrust. Asset prices are the visible symptoms of structural shifts. The mechanics of global finance, margin requirements, and liquidity ratios govern the movement of capital across the system. Gold remains the ultimate monetary anchor, but in a highly leveraged system, even a heavy anchor can be dragged during a storm before finally securing the portfolio in the new monetary regime.